Welcome to the Deep Dive. We are plunging into a piece of cutting-edge research today that sits right at the intersection of AI, optimization, and, well, the rapidly evolving energy grid.
Yeah, specifically, we're looking at a paper called Maximizing Battery Storage Profits via High-Frequency Intraday Trading. And it tackles a really crucial question for the future of renewables. How can those big grid-scale battery energy storage systems, BEES, how can they actually make serious money, especially in these super fast, continuous intraday electricity markets?
Right, and the big hurdle they identify, it seems, is that the traditional ways of optimizing how batteries are used, they just aren't built for that kind of speed.
Exactly. They're too slow. They can't react to market shifts happening in, milliseconds. Or the alternative is they simplify the market so much they kind of lose accuracy.
Okay, so what's the fix proposed here?
Well, the paper puts forward a novel solution. It's a dynamic programming approach, a DP approach, that's designed to be lightning fast. It adapts a pretty well-known strategy, the rolling intrinsic, but for this high-speed environment.
And the speed up is the really exciting part, isn't it? They achieved, orders of magnitude faster.
Yeah, orders of magnitude, which is key because it lets them do realistic backtesting over long periods, actually simulating things at market speed. That was kind of prohibitive before.
And the payoff, what did the results show?
Pretty compelling, actually. They ran backtests using a whole year of German market data. And this high-frequency strategy, built on their fast method, it earns significantly more profit. We're talking a whopping 58% more than if they just optimized hourly.
Wow, 58%.
And still a solid 14% more profit, even compared to optimizing minute by minute, which is already pretty frequent.
So it really drives home that speed isn't just, a nice-to-have feature. It's absolutely critical for making money in this market.
Definitely.
Okay, that's a fantastic summary to kick us off. Great overview. Now let's really unpack this paper. Before we dive into the weeds of the strategy itself, maybe let's quickly set the stage. Why are these BES systems so important right now?
Well, you see it everywhere, right? Yeah. We're adding more variable renewables, solar, wind onto the grid. And that brings challenges for stability. The sun isn't always out, the wind isn't always blowing.
Sure, intermittency.
Exactly. So batteries are becoming essential. They can soak up excess power when it's abundant and cheap, and then inject it back really quickly when demand spikes, or maybe when a renewable generation suddenly drops. They provide that flexibility the grid just desperately needs more of.
And we are seeing those installation numbers climb pretty dramatically, which reflects that potential being recognized.
For sure, but potential isn't enough on its own. For these systems to be deployed at the scale we need to really support the energy transition, they have to be economically viable.
They need to pay for themselves.
Right. So in liberalized markets, they make money through different services, things like frequency regulation, demand response, and crucially for this paper, energy arbitrage, buying low, selling high.
And the intraday market is where a lot of that action is happening now.
It's becoming increasingly important for that arbitrage, yeah. The trading volumes are growing, there's more volatility, it's a key area.
So this paper zooms in specifically on that intraday opportunity. And you mentioned it's a continuous market. That's different from, say, the day-ahead market where things clear at set times. What does continuous really mean for someone operating a battery?
It means the price is constantly moving, nonstop, based on new buy and sell orders hitting the market in real time. So if you're operating a battery, you need to be able to react instantly, potentially making decisions, like we said, millisecond by millisecond.
And figuring out if a strategy actually works in that environment. That requires serious simulation, right, over long periods.
Huge amounts of historical data, yeah. Which gets computationally very intensive very quickly.
Right, because most of the earlier research, as the paper points out, might have looked at slower markets, or maybe they simplified the intraday market, treated it like discrete time steps instead of this continuous flow.
Yeah, or they didn't fully model the complexities in the order book. Or they just used very simple trading rules, like sell if price hits X, buy if price hits Y. Kind of basic stuff.
Got it. So the core contribution here is really twofold. Developing a high-frequency strategy that does grapple with all those complexities, the order book dynamics, the market rules, the battery's own physics, like efficiency and degradation.
Right. And then critically, creating a way to solve that complex problem fast enough to actually trade, or at least realistically simulate trading at the speed the market demands.
Okay, let's dig into that battlefield then. You mentioned the German market. Tell us a bit more about the European intraday market structure they focused on.
Sure. So the paper primarily uses data from the German market, which is traded on EPEX spot. It's the largest intraday market in Europe, volume-wise. And it's part of this bigger interconnected system called the Single Intraday Coupling, or SIDC, that basically links up various national markets across Europe, allowing for cross-border trading closer to real time.
And what's the main purpose of this intraday market for participants, like utilities or generators?
It's essentially their last chance to adjust their positions. Let's say your forecast from the day before was off. Maybe the wind didn't blow as much as you expected, or a power plant tripped offline, or demand is higher than predicted.
Okay.
You use the intraday market to buy or sell power to get back into balance. This avoids penalties you'd otherwise face from the grid operator for causing an imbalance. And all this need for last-minute adjustment creates price volatility.
Which creates the arbitrage opportunities for assets like batteries.
Exactly. Buy when someone's desperate to sell, sell when someone's desperate to buy. And because it's continuous, you're not waiting for some big auction to clear. You can trade specific products like hourly blocks, 30-minute blocks, even 15-minute blocks of power delivery, right up until about 5 minutes before that power actually needs to flow.
Wow, okay, 5 minutes, that's close.
Very close. And the mechanism making this all happen is the limit order book, the LOB.
Okay, let's pause there. For listeners who maybe aren't deep in electricity market trading, what exactly is a limit order book in this context?
Right. Imagine it like a transparent two-sided list for a specific product, say electricity delivered between 3 and 4 p.m. On one side, you have all the bids people wanting to buy power for that hour, listed with the prices they're willing to pay, sorted from the highest price down.
Like a highest bid first.
Highest bid first. And on the other side, you have the asked people wanting to sell power, listed with the prices they're willing to accept, sorted from the lowest price up.
Lowest asked first. The best offers on top.
Exactly. So when you as a trader submit a new order, maybe you want to buy, the market's matching engine instantly checks. Is your buy price high enough to meet the lowest ask price currently in the book? If yes, boom, a trade happens. You buy at that best available ask price.
And if your order is bigger than what's available at that best price?
It'll take out that first price level, then move to the next lowest ask price, and so on until your order is filled or you run out of asks within your price limit. If your order doesn't fully match immediately, or if you set a limit price that isn't met by any current asks, your remaining order just sits there in the bid side of the book, waiting for someone else to come along and match it. The paper actually has a nice little diagram, figure 1, showing this.
So it's this constantly shifting, real-time picture of supply and demand at very specific price points.
Constantly shifting is right. And that leads to some big challenges, especially for something physical like a battery. One major one is liquidity. How many bids and asks are actually in the book at any given moment?
Right.
Figure 2 in the paper shows this really well. Hours before the actual power delivery, especially say early in the morning, trading for a product delivering late in the evening, the book can be pretty thin.
Not many orders.
Not many orders. Which means the gap between the highest bid price and the lowest ask price, the bid-ask spread, can be really wide. Trading, then, is risky. The price might not really reflect the true value yet, and your order might significantly move the price if it's large.
Yeah, that figure 2 is striking. You see the volume, the number of orders, it just ramps up exponentially as you get closer to the actual delivery time. There's a noticeable jump around, 10 or 11 hours beforehand?
Yeah, exactly. So trading way out in those illiquid periods, you might get a worse price. Or maybe your order just sits there and doesn't get filled.
Okay, so liquidity varies a lot. What's the other main challenge?
Just the sheer frequency of updates. They mentioned in the paper, for Germany in 2021, there were 240.4 million order submissions.
Wow.
That averages out to 7.6 orders hitting the book every second.
Every second.
Yeah. So if your algorithm, your decision-making process takes even, say, 5 seconds to figure out what to do based on the current LOB, well, the LOB has potentially changed dozens of times already. You've missed those micro opportunities. You need to be incredibly quick.
Okay, so high frequency, complex order book, varying liquidity. That definitely sounds like a tough playground for a simple trading strategy, which brings us to the strategy they started with, this rolling intrinsic or RI strategy. What's the basic idea behind that, and why did they need to adapt it so heavily for this market?
So the standard intrinsic strategy, it's almost like a greedy algorithm. It's quite common in optimizing things like natural gas storage. Basically, it looks at the current price structure right now across different delivery times or maybe different locations, and it asks a simple question. Can I make an immediate guaranteed profit by using my storage flexibility right now? Like buy low now, sell high for the next hour, based purely on current prices.
So it doesn't try to guess future prices,
Yeah.
no speculation.
No speculation. It's myopic is the term they use. It only cares about the immediate, observable profit opportunity. If the price difference between buying power now, considering LB asks, and selling it for delivery next hour, considering LOB bids, is positive and covers your costs like efficiency losses and fees, it just does it. It doesn't worry if maybe waiting 2 hours might yield an even bigger profit.
Okay. Simple, low risk in a way because you're not forecasting. Sounds like a reasonable baseline, maybe.
Exactly. It serves as a common benchmark. But applying that standard concept directly to a continuous electricity intraday market with a complex limit order book, that's tricky. The original RI often assumes you can just, buy or sell whatever quantity you want at a single market price, like in a perfectly liquid futures market.
Which we just established is not how the LOB works, right? You've got discrete price levels, limited volumes at each level.
Precisely. Plus, you have to factor in that continuous stream of orders changing the book constantly. You've got specific market rules, minimum trade sizes, and then there's the battery, its physical limits, the energy loss during charging and discharging, or efficiency, and the fact that cycling it causes wear and tear, which has a cost, degradation.
So they had to build all of that into their mathematical model of the strategy.
Yes, exactly. They show how incorporating all these real-world factors leads to formulating the optimal myopic trading decision at any given moment as a mixed integer linear programming problem. That's equation 2 in the paper.
Mixed integer, meaning it involves both continuous variables, like how much power to trade, and binary yes-no type decision.
Right, like the decision, should I be buying or selling right now? You can't do both. Or decisions related to efficiency losses, especially around zero or negative prices. The integer part makes the problem computationally harder than a simple linear program.
And did they manage to include those real-world costs, like efficiency and degradation?
They did. They factored in the battery's round-trip efficiency, for example. If it's 95%, you lose 5% of the energy in a full charge-discharge cycle. And they included a variable cost calculated per megawatt hour of energy withdrawn from the battery.
Okay.
This cost combined estimated trading fees with a degradation cost. They modeled degradation linearly based on energy throughput, essentially estimating the cost of eventually replacing the battery cells spread over their expected lifetime cycles. They justify this based on projected replacement costs.
Okay, so they built a pretty detailed, realistic mathematical model capturing this adapted rolling intrinsic strategy for the specific complexities of the continuous intraday market and the battery. But then we hit the bottleneck you mentioned earlier.
Yeah.
Solving this MILP problem is too slow for high-frequency trading or simulation. Why is that?
Well, solving a MILP, even one that looks relatively straightforward for a single point-in-time decision, can require significant computation. Because of those integer or binary variables, the solver often has to explore many different combinations of decisions to guarantee it finds the absolute best one. It's not like solving a smooth, continuous problem.
Okay.
So, if you need to solve this problem potentially millions of times over a year, every time the top of the bid or ask stack in the LOB changes in a way that might trigger a trade, the total computation time just explodes. You simply cannot solve the full MILP fast enough to keep up with those 7.6 order updates per second and make a timely decision based on the current market state. Running a realistic simulation for a whole year using MILP would take, well, ages. Way too long.
And that's where their dynamic programming approximation swoops in. This seems to be the core innovation for speed.
Yeah.
How do they reframe the problem to make it solvable so much faster?
Right. So the fundamental idea behind dynamic programming, DP, is breaking down a complex multi-step decision problem into smaller linked stages. In this case, they cleverly treated each electricity product, basically each delivery hour, as a stage in the sequence.
Okay, stages or hours, what links them?
The state variable that connects one stage to the next is the battery's state of charge, its SOB. So the decision you make for trading product to, say, the 3-4 p.m. hour depends on the SOC you have entering that stage, and the trading action you take, buy, sell, how much, determines the SOC you have leaving that stage and entering stage +1.
Makes sense. How does the DP actually make the decision?
The DP formulation, which is equation 4 in the paper, works on the principle of optimality. It basically says the maximum value you can achieve from this stage onwards is the sum of the immediate profit you get from trading the current product, based on the LOB right now, plus the maximum possible value you can get from all the future stages, starting from the resulting SO. This future value is captured by something called the value function, often denoted V for the next stage.
Okay, so you're maximizing current profit plus the expected future value. How does DP calculate this faster than MILIP?
Typically, DP approaches solve this kind of problem backwards in time. You start at the very end, say, the last delivery hour you care about, where the future value might be 0, and you compute the value function for all possible states, so C levels, at that final stage. Then you step back one stage and calculate the value function for that stage using the already computed values from the next stage. You work backwards until you reach the beginning.
And once you have all those value functions calculated,
Then, moving forward in time during actual operation or simulation, you can quickly look up the pre-calculated values to make the optimal decision at each stage based on your current state.
but didn't you mention a complication with battery efficiency? That when you charge or discharge, because of losses, the resulting soak might not land neatly on, say, 50% or 60%. It could be 53.7% or something awkward.
That's exactly the snag. Standard DP works most efficiently when you have a nice, discrete set of states. Because charging and discharging with realistic efficiency losses can lead to sus levels that fall between any predefined grid points, like every 10%, they introduced a crucial approximation.
Okay. What's the approximation?
They define and calculate the value function only on a fixed, discrete grid of SoCal levels, say 0%, 10%, 20%, up to 100%. Then, if an action results in a SO that falls between two grid points, say 53.7%, they estimate its value using simple linear interpolation between the calculated values at 50% and 60%. That's equation 5.
So they trade off a tiny bit of exactness for a huge gain in computational tractability because they only need to calculate and store values at those fixed grid points.
Precisely. They do mention in a formal proposition, Proposition 1, that in theory an exact grid of all reachable states does exist, but actually constructing and using it would be computationally infeasible for a realistic battery and market. So this interpolation on a coarser grid is really the secret sauce for the speed up.
And how much faster are we talking here? Do they quantify it?
Oh yeah, orders of magnitude faster. Table 2 in the paper compares the DP solution time against the MILP solution time for some weekly test periods. The DP is consistently 100 to 1,000 times faster.
Wow. That's massive.
It is, and they tested different grid granularities, how many points some are in that discretized Lissy grid. Even with a relatively coarse grid, like just 11 points, M11, so every 10%, the DP was dramatically faster than MILTIO. And interestingly, gave very similar profit results in those weekly tests.
And that speed is what makes the high-frequency simulation possible. It lets their strategy react to effectively every relevant change in the order book, like every time the best bid or ask price updates. That's how you potentially capture those really fleeting arbitrage opportunities that slower methods would miss entirely.
Exactly. It closes the loop. The speed enables the high-frequency approach.
All right, the theory sounds solid, the speed up is impressive.
Yeah.
But how did this DP-based strategy actually perform when they put it to the test in a realistic backtest? Let's get into the results.
Okay, so they set up a pretty standard case study. A 10 megawatt battery with 10 megawatt hours of energy capacity. That's a 1 hour duration BESS, which is quite common for grid services.
Okay, 10 milliWs. What about efficiency and costs?
They assumed a 95% round trip efficiency. So for every 1 milliwatt you cycle through, charge, then discharge, you lose 0.05 milliWh. And they used a variable cost, which they calculated as 4.09 euros per MLW discharge.
And that cost covered?
About 4 euros for battery degradation, that linear cost based on throughput we talked about, and roughly 0.09 euros for exchange trading fees. Pretty realistic numbers.
What data did they use for the backtest?
They used the full year of 2021 German hourly EPEX intraday market data. That includes all the order book information. And they respected the market rules, like the minimum trading unit of 0.1 milliWh.
Did they account for real-world delays, like the time it takes to run the calculation and send the order?
Yes, that's important. They modeled not just the algorithm solve time, which was fast for the DP but not 0, but also a minimum technical delay. Think network latency, communication time. They set a minimum total delay of 200 milliseconds between an LOB update happening and the strategy being able to react to it.
Okay, 200 meters. That seems reasonable.
Yeah, and they also acknowledge a standard limitation of backtesting like this. It assumes the strategy's trades don't actually impact the market prices or influence how other people trade. In reality, large high-frequency trading can have some impact, but modeling that is another layer of complexity.
Understood. So with that setup, what did the big yearly backtest show?
Figure 3, right?
The cumulative profit.
Yes, figure 3 tells the main story. It's pretty dramatic. The fastest strategy, the one using their DP method, reacting to every relevant LOB update, it ran the entire year's simulation in just 86 minutes, which is incredible in itself.
86 minutes for a year of high-frequency trading sim. Wow.
Right, and it earned a total profit of 349,000 euros.
Okay, 349K. How does that compare to slower, maybe more conventional approaches?
Well, they compared it to a strategy that only re-optimizes and trades once per hour, a much simpler approach. That strategy earned 221,000 euros. So the fast DP strategy made 58% more profit.
That's a huge difference. What about optimizing more frequently, say, every minute?
Even compared to optimizing minute by minute, which is still quite active, that strategy earned 306,000 euros. So the super fast DP strategy still came out ahead by 14%.
So the conclusion seems unavoidable. Reacting faster directly translates to significantly more profit in this market.
It couldn't be clearer from their results. You can literally see it in figure 3. The blue line representing the fastest strategy, it just steadily pulls away from the orange, minute, and green hourly lines over the course of the year.
And they mentioned something about the profit increasing towards the end of 2021.
Yeah, they noted the slope of that cumulative profit curve got noticeably steeper in the last few months of 2021. And they linked that to the broader energy market situation at the time, particularly rising natural gas prices in Europe, which led to increased volatility and bigger price swings in the intraday electricity market. More swings mean more opportunities for a fast-acting battery to capture.
Interesting. Beyond just the total profit, did the results give any insights into how the battery was actually operating day to day? Figures 4 and 5 looked at trading behavior, right?
They did. Figure 4 shows the annual state of charge profile, kind of mapping out how full the battery was over the year, and you definitely see a clearer daily pattern. That suggests the strategy is successfully capturing those typical diurnal arbitrage opportunities, charting during lower-priced periods, like midday solar peaks or overnight, and discharging during higher-priced evening peaks.
Which makes sense. Was there anything surprising about the SULC profile? You might expect a 1-hour battery doing arbitrage to just constantly slam between fully charged and fully empty, what they call bang-bang control.
Right, that's often what simpler models predict if you're just reacting to a single price signal. But interestingly, their results showed the battery spent a surprising amount of time at intermediate states of charge, not just full or empty.
Why would that be?
They suggest it's a consequence of actually trading within the limit order book. Instead of just one big buy or sell order based on the best price, the strategy might be making multiple smaller trades at different price levels as it walks the book. This leads to more nuanced charging and discharging behavior. It kind of highlights the value of their more realistic LOB modeling compared to just assuming a single market price.
And did the amount of trading activity match the profit trend?
Yes, another plot in figure 4 shows the daily traded energy volume, and that activity clearly ramps up towards the end of 2021, mirroring the increased profits we saw in figure 3 during that volatile period. More opportunity led to more trading.
Okay, now what about figure 5? That looked at when the strategy submitted its orders relative to the delivery time. How did that compare to the overall market activity shown back in figure 2, which peaked closer to delivery?
Yeah, this was quite interesting. Their RI strategy, even this fast DP version, tended to submit its orders more uniformly across the time until delivery axis compared to the average market participant.
Meaning it traded more in those earlier, less liquid hours.
It seems so. It traded a fair bit quite far from the actual delivery time. And the reason they suggest is inherent to the myopic nature of the RI strategy. It's always looking for any immediately profitable spread. That includes temporal spreads, like buying power for delivery 12 hours from now because it looks cheap compared to the price of power right now or in the next hour.
So it might jump on an early small spread even if liquidity is low, because it's not trying to predict if a better spread will appear later when liquidity is higher?
Exactly. It's a consequence, and maybe a slight weakness, of being purely myopic. It doesn't strategically wait for potentially better conditions closer to delivery time. It just takes the first profitable opportunity it sees.
Got it. They also sensitivity tested some key parameters in Table 3, didn't they? How things like efficiency or battery size affected the results.
Yes, they ran variations. They looked at the DP grid granularity, the battery's round-trip efficiency, the assumed degradation cost, and the battery's energy storage capacity.
And what are the main takeaways there?
Well, some were pretty intuitive. Higher efficiency, less energy lost meant higher profits. Makes sense. Lower degradation cost also meant higher profits. Using a finer grid for the DP approximation, more points around them, generally led to slightly higher rewards, presumably due to better accuracy, but the speed gains from using coarser grids were substantial, and the profit difference wasn't huge.
That point about degradation costs seems particularly relevant for the industry, doesn't it? Given how battery costs are evolving.
Absolutely. They make that point explicitly. As battery technology continues to improve and replacement costs hopefully keep falling, that degradation cost per cycle will decrease. And that directly translates into higher profitability for these kinds of high-frequency, short-duration cycling strategies. It could make them significantly more attractive economically in the near future.
What about the battery size or duration?
Also quite interesting, they found that smaller capacity batteries comparing, say, a 5 milliwatt battery to their baseline 10 milliwatt yielded higher profits per milliwatt of capacity.
So the 10 milliwatt battery made more total profit than the 5 milliwatt one.
Yes, total profit was higher for the larger battery, but it wasn't double. It seems the larger battery participates in more trades overall, but the extra trades it enables, beyond the best opportunities captured by the smaller battery, are perhaps less profitable on average, diminishing returns per unit of capacity. They also tested a longer duration battery, a 2-hour battery, 10 milliW, 20 milliW, versus the baseline 1 hour. The 2-hour battery also earned less profit per MWH of capacity than the 1-hour one, although again its total profit was higher. This might suggest that shorter duration batteries are potentially better suited, or at least more capital efficient, for specifically targeting these very fast fluctuations in the intraday market.
Right. And finally, there was this really neat part where they showed how the speed of their DP method wasn't just for faster simulations, but could actually be used to improve the trading strategy itself through parameter tuning.
Yes, this directly addresses that weakness we just discussed, the myopic RI sometimes trading too early in illiquid conditions. Because their DP solver was so fast, they could afford to add a bit more intelligence.
How did they do that?
They introduced a simple parameter, let's call it phi, which acted as a penalty in the optimization. This penalty was applied whenever the strategy considered trading a product that currently had a wide bid-ask spread, indicating low liquidity.
So it discourages trading when the market is thin and prices might be unreliable or costly to execute on.
Exactly. It encourages the strategy to maybe wait a bit, hold off until closer to the delivery time when liquidity typically improves and spreads narrow.
And the key was that the DP was fast enough to allow them to train this penalty parameter.
Precisely. They used a sliding window approach. They'd look at the market data from the previous month, run simulations to find the optimal value of that maximized profit in that past month, and then use that optimized value for trading in the current month's simulation. This kind of optimization loop would be computationally infeasible if each simulation run took days or weeks, like with the Myopic.
Right. You need the fast core solver to make that feasible. And what was the impact of optimizing just that single parameter?
It resulted in an 8.4% increase in the total yearly out-of-sample profit. The profit jumped from the baseline 349,000 euros. Actually, they reran the baseline slightly differently for this comparison, getting 347K, but it jumped to 376,000 euros.
Wow, an extra 8.4% just from tuning one parameter to avoid illiquidity.
Yeah, it's a significant bump, and it really drives home the point that the computational speed they achieved isn't just about getting results faster. It's an enabler for developing smarter, more adaptive, and ultimately more profitable trading strategies.
Okay, this has been a fascinating deep dive into what feels like a genuinely impactful piece of research. So just to recap the core achievement, they've developed a fast, accurate, dynamic programming method specifically tailored for high-frequency battery trading in these really complex, continuous intraday electricity markets.
And the results pretty conclusively show the tangible profit potential that's unlocked by being fast enough to keep up with the market's millisecond pace, and also detailed enough to model the important nuances, the order book structure, the market rules, the battery's own physical characteristics and costs.
Right, and that speed itself creates this virtuous cycle. As we saw, it enables further optimization of the strategy itself, like tuning parameters to avoid bad trades, squeezing out even more value.
So what does this all mean for you, the listener? Maybe you're an AI researcher, an ML engineer looking for real-world problems, or perhaps someone working directly in energy systems or trading. I think this paper is a great example of the practical value you get when you overcome computational barriers in optimizing complex dynamic systems. It shows that maximizing value from assets like batteries in these fast markets isn't just about finding a strategy, but finding one that's fast enough to execute and validate realistically and detailed enough to capture what actually matters.
Yeah, it connects the algorithmic innovation directly to bottom line performance, and it definitely leaves you thinking about what comes next, which the authors touch on briefly. They suggest potential future research directions. Things like exploring more complex ways to parameterize the trading strategy, maybe using machine learning.
Or coordinating trading decisions across multiple markets simultaneously, maybe linking intraday trading with day-ahead positions, or even ancillary service markets like frequency response. And of course, integrating sophisticated dynamic price forecasts, perhaps from external ML models, into the decision-making.
Right, and that leaves us with a pretty compelling question to ponder, doesn't it? Given how much extra profit they found just by increasing the reaction speed and tuning a single simple parameter based on historical spreads, how much more value could potentially be unlocked if you integrated really good predictive forecasts of future price movements or optimized bids across multiple market platforms at once, all enabled by this kind of fast solution framework.
Exactly. It really feels like there's still significant potential to uncover as these optimization techniques get faster and smarter, and as they integrate more sources of information. Definitely something to keep an eye on in the grid optimization space.